All right, just in time for me to figure out the color. And this is the REI Rocks review. I'm Dan Fradenburgh. I'm here with Jason Williams and George Roberts III. We'll start off with George. How you doing today, George?
Fabulous. Thank you for having me today, Dan.
It's a pleasure. It's a pleasure for sure. Jason, how are you doing?
I'm doing well. Friday morning already. Seems like we just did this yesterday. So.
Right. That's really it. And I see Angel is hopping in as well, but she's having some camera difficulties. It hit me that one thing we neglect to do in these REI Rocks reviews is really give some context to the fact that we do commercial real estate. That's really what we're up to. And we do these REI Rocks summits twice a year. Angel, I hear your mic's coming through now. Do you want to tell everybody what we do on these REI Rocks reviews?
I can. So what we do is we come back and check out previous summit sessions, and we help you as the listener or as the watcher really see how to pick out the important pieces and create some actionable steps from those pieces so that you can get to where you're wanting to get to.
I love it. I love it. And today we got George Roberts III. He's telling us about, you're also known as the data scientist of real estate. I love that little moniker there. And my favorite thing, yeah, exactly. My very favorite part about you though, is that your findings tend to be quite optimistic, at least for people in real estate. So that's pretty exciting because you don't have to look too far to find someone who's all doom and gloom. And I don't think that that's really in lines with the reality. But do you want to say a thing or two about the presentation, or do you want to introduce yourself? What do you want to do, George?
Well, sure. I want to thank you for that introduction, Dan. And I will say there's a lot of doom and gloom out there. That's the easiest way to get clicks. But we're not here to make clicks. We're here to make accurate predictions. And we'll see how some of these predictions have panned out, because it's been a few months. What are we, 2 or 3 months in from this now, huh?
Mm-hmm, yep. Mm-hmm. That's exactly right. That's exactly right. And the reason why we're able to do all of this stuff is because we have people paying our bills. We have sponsors. And so I want to remind everybody, in case you were unaware, that this space could be yours if you want to get more eyeballs as syndicators or whatnot. But I want to quickly go to Angel's bit about Sponsor Cloud. So let's do that.
Hey guys, it's Angel, and we are super excited to announce our newest gold sponsors, Sponsor Cloud. If you're wondering what Sponsor Cloud is the one-stop shop for sponsors to automate, to delegate, to execute every aspect of their syndication projects, from affordable PPM generation to investor relationship management to fund administration and compliance, exclusive capital raising networking events. Plus, for the REI Rocks community, they're going to offer free migration and customer success services when switching from another provider. That's like a $2,000 value. So contact Sponsor Cloud, contact them today, and see how much time and money you can save. You can visit them at sponsorcloud.io/contact and make sure you let them know that you're part of the REI Rocks community, because these sponsors are the reason why we are able to continue offering affordable and low cost, no cost education, summits, information, knowledge, experiences, all of the things that we're able to find and bring to y'all. It happens because we have sponsors like Sponsor Cloud. So check them out, see how they can help you out. And Sponsor Cloud, thank you.
All right, beautiful. And I see that it still has that this space could be yours here. And so I need to get rid of that. But I'm also trying to share the screen on here at the same time. Holy moly, I got so much stuff to do. And we got comments too. Good morning to Amy Silvis. We're about to get started. The other thing to keep in mind here is we do watch these at 1.5 times speed. So do not adjust your television set. It's for real. So let's do this.
Hey guys, it's Angel. Just thank you for being here. This is
And I
my
guess it helps
favorite
if
6
we
days of the year
unmute
because
it
we
or
do this
something.
twice a year,
It's
two
not coming
3-day
through.
conferences, and it's amazing. First off, if you want to stay on this side, there is probably about 35 hours of content over here that is totally free for you. That there is a super sneaky way to get over to the live side. If you go ahead and do that VIP subscription, if you don't see the QR code, if you don't see the link, I will personally take care of that for you and make sure you have that option. So the benefit of being on the VIP subscription is that you get all of the content from all the semesters. There's over 40 hours of content. Guys, I've said this every single time, I think, but I didn't get to where I am from reading a bunch of books and listening to a bunch of podcasts. I did all that. It was these one-on-one interactions, these recordings, all of this information. This is what really helped me get to where I am. And I would love to share that with each and every one of you. And so that VIP subscription is an amazing, amazing opportunity to do that. So now that is out of the way, I'm going to introduce my friend George. George is amazing. He has presented on some of the economic uncertainty, what he has kind of done some predictions on. And so we get to hear a little bit about that. And then we're going to hear some more about investing in uncertain times, because in the current economic landscape, I think the only thing is certain is the uncertainty. So the volatility, the tumultuousness of it. And I'm just excited to hear what you have to say, George. So if you want to take it over, we can get going.
Well, thank you, Angel. And you might be wondering after an introduction like that whether you should be investing at all, but no worries. I brought my friend here, Sun Tzu, to remind us that in the midst of chaos, there is opportunity. We're going to focus on single family in this presentation, even though many of us may be more interested in multifamily or other facets of commercial real estate, just because there's so much data out there. And of course, economics being the study of scarce resources with alternative uses, what we're learning over here is going to be of direct relevance to the multifamily space, if that happens to be where you're at. So last time, and actually before we get to our predictions from last time, I've actually invited somebody else to come, and he's late sometimes, but it's a little embarrassing. Oh, here he is. Oh, why here? It's the data scientist of real estate, and he's here to make sure that we don't go any further than the numbers would warrant.
Awesome.
So we made some predictions last time. We talked about how the U.S. is not likely to suffer a housing crash. However, there are many places around the globe that are likely to see a housing crash before the United States. And lo and behold, let's take a look at how that turned out. Australian home prices down 8.9% from peak. Canadian home prices, record price drop, down 13% from peak in February. Toronto home prices down 22%. China's home prices slumping for 16 months, and Hong Kong down 15.6%. Now, how is the US faring through all this? It turns out we've only dropped about 2.5%. You may wonder why our housing market is so resilient. And let's go through some of those factors. The chief is number one on the list. It's housing undersupply. Now, before we get any further and talk about how great things are, let's understand that clearly we do have an affordability crisis. Our home price to median income ratio is above 7. This is a region that we can't expect to stay in forever. However, we do know that we've been underbuilding for a long time. We have very, very little supply on the market. So even though these prices under ordinary circumstances would be unsupportable, these are not ordinary times. Take a look at what's happened so far. We've seen a 2.5% decline per the Case-Shiller. Meanwhile, interest rates have risen insanely from seeing a 2-handle a year ago to 0.08%. So why have home prices been so resilient? Remember, most of the time when we're having economic troubles or home price declines, et cetera, the Fed is doing just the exact opposite. So how have we managed to swim upstream? Well, the first factor is that construction is far behind historical norms, and this is tending to support home prices. And also you have sellers that are locked into these incredibly low rates. Who wants to leave your current mortgage only to go into a much higher payment, maybe a smaller home? So we have very little housing supply on the market, not only because it isn't being produced, but because that which exists is being held back. Now, during the pandemic, we saw that our leading indicators of construction permits and starts got really high, close to 2 million, almost at one point. Well, what happened? Those homes were never built, and we've kind of crashed down to our leading indicators being around 1.5 million, which is, by the way, our historical long-run average of homes constructed in the United States on an annual basis. This is just what it takes to replace what becomes obsolescent and also to account for a growing country. All right, Dan, you want to stop it? Let's talk about some of the things we've seen. So you can see, there are more countries that have experienced crashes. We could add Sweden to the list. I think they're down at least 15% from their max last spring. And yes, I made the prediction that we're actually going to see some increase or at least stasis in the home prices. And I'm really excited to say that that's been borne out. So we saw a couple slides back that we got up to 7.08. That's the Freddie Mac primary mortgage market survey. And that was November 10th of last year, was the second and final time we hit that peak. Yesterday, we saw that those rates had come down about 3 basis points. I think we're about 6.39 today as of May 4th. And as expected, we see that home prices in February, that was our most recent Case-Shiller, and that just came out a few days back, April 26th. And we see that we're up, I want to say about 16 basis points, January versus December, or was it February versus January? But we got actually March data coming in too. If you're going to take a look at median home prices for existing homes, median home prices for new homes, we're seeing almost 5% rebound in March. So that's just allowing us to sort of peek around the corner. We'd love to see what Case-Shiller has to say. It's going to take us till the end of the month to see that. But again, wow, home prices are back. We're on the march.
It's really interesting. I can also verify personally that in Canada, yeah, those prices are like those price drops are real. I haven't been pricing them this week, but lots of reports in the last month or so, especially Ottawa area dropping by as much as like $100,000. Of course, that's the maple syrup smelling communist dollars, not freedom dollars. So they're not worth as much. But there we go. Okay, Angel's at a loss for words. Let's continue.
We're all at a loss, Dan. You're amazing, though. Keep us laughing.
The inventory is low and declining. You'll see some people saying like, oh, well, hey, it's kind of recovering, but recovering from what? We still have historically low inventory. So when you see all these headlines like, oh, yeah, we're seeing a recovery in the inventory. Well, from what? What should we expect? These are things that the headlines just don't tell you. Now, I mentioned, how bad is this housing shortage? Well, depending on how you calculate it, if you look in terms of household formation, people will say, oh, yeah, maybe we're 5 million behind. Well, if you consider that we really do need about 1.5 million units to keep up, we're about 8 million behind. And a lot of this is pent up demand. We had a major recession. And so a lot of those households were just simply never formed. You have more people living together. That's what happens when you have a major housing crisis. So although this is sad, we have to remember there's also opportunity here. And for people like us who happen to be interested in providing housing, this is an opportunity for us to use those incentives in our economic system to provide the housing that people need, whether it's building new housing or it's simply maintaining the housing stock that we currently have. Now, when you look at interest rates, and actually I do think that I did want to talk about interest rates first, it doesn't really tell the whole story. I mean, when you say, gosh, we went from rates in the twos to rates, at least briefly, 7.08%, and we hit that peak twice, gosh, it's actually much worse than that, because think about what happens to your payment. And this is really where it gets frightening. When you see payments for your ordinary home of around $900, $1,000, $1,100 over the last 20 years, and all of a sudden, well, my goodness, we've almost doubled. And although we are ticking back a little bit, as you do see, rates have slid back our way a good bit. These are extraordinarily high home payments, forcing a lot of people to become renters and all that goes with that. So what's happened in the meantime? Well, inflation fears have eased. We may have topped out, not making any predictions on that yet, but we have slid down from our highs. But also the fears of bondholders. I mean, you have these relatively long duration bonds, and who really wants to go into that without a little bit of a cushion? Well, if you see that inflation is coming back down and the likelihood of these continued rate hikes, especially at the rates we've been seeing, like 75 basis points each time. We had 25 in our most recent meeting of the FOMC, but again, it's not like it was. All right, so what are some other things that might lead us to believe that things could possibly continue to go our way in the housing market? Maybe we'll see lower rates. We'll take a look at that 30-year mortgage versus the 10-year Treasury spread. So what are these bondholders essentially demanding? Of course, I'm comparing primary to the 10-year, but you get the idea. I mean, we're looking at the impact of those rates. So normally we have a spread of about 172 basis points. Well, we're actually just over 1% higher than that right now as we record this in the middle of February. So if we just saw spreads return to historical levels, we could see mortgage rates slide another 1%. Of course, we probably have the countervailing impact of that there could be some further Fed rate hikes, et cetera. We don't know what's going to happen yet. But again, just given current information, we are probably way above where we probably need to be. All right, so that doesn't mean that everything is all good and fine. I mean, what if the Fed decided, oh, we're all done hiking? Doesn't mean that rates are going to fall the next day. And if you look at this historical rate chart, the Fed, when they stop hiking, usually we have to wait an average about 8.7 months before we see the beginning of the declining leg of the cycle. So again, we don't expect that we're done with hikes. And certainly, even if we were done, it's going to take a while to see some easing up. But a lot of strategy that goes into this, right? Now it's time to consider how long do you want that prepay penalty, for example. I mean, I could even see in some cases, I saw, I think actually more than one bank that was offering me no prepay penalty. And these were non-recourse loans, to be clear, but that's kind of, I'm sorry, they were recourse loans, not the non-recourse loan that I wanted, but that's sort of tempting. I mean, to imagine that, gosh, 6 months from now, 1 year from now, not even a step down. So things to think about.
There's a good time to pause. We're now 15 minutes in. It's funny, the private chat between us, it's just blowing up with all these different things about residential in particular. It's really funny. And but the thing I wanted to ask George about real quick, so if you regularly watch business news and things like that, or non-business news and just more mainstream, you're going to get one version of the story. It's usually pretty gloom and doom and negative in general. So I think one thing that gives you a lot more confidence, George, in your understanding of what's coming down the pipe is looking at this data itself directly and letting it tell its most likely more nuanced story, right? Like, can you say a thing or two of like where, it gives you a little bit more confidence that where the truth is, what's going on? Is that too vague of a prompt?
I love it, Dan. And you're right. The chat is blowing up. I think we're having a little too much fun. So let's let people into all this excitement. Yeah, we've been talking about product risk and the ARMs. So there's at least two reasons why we don't have the floating rate risk that we had last time. One is that we had super low rates and you just didn't have much of a spread. Why would you take an ARM if rates are already super low? And if you're not getting, much of a discount, it doesn't make much sense. And then Jason also pointed out, hey, 2008, a lot of people got burned on those ARMs. And I think that there is a lot of living memory of that, okay? Those of us who were homeowners in 2008, we saw people get burned, or maybe you saw your parents get burned, or your friends, or uncle, cousin, whatever. Wow. The ARMs are just not what they used to be. So we have so many differences now, right? We've got more home equity, we have less product risk, and we have, as we showed maybe 5 or 7 slides ago, there are very few homes on the market. Very, very few, because why would you want to go and let go of the best mortgage you have ever had to go and move someplace and pay twice as much for 2/3 as much of a home? And it doesn't make sense unless you just won the lottery or you have to move to remain employed. And on the other side of it, and again, a lot of us are here in commercial real estate. If your building is performing better than it ever has, do you really want to sell right now at a discount? No. And so the sellers are saying, this is the price. And we're seeing some discounts, not fire sales, but we're seeing some discounts. And they're saying, look, if you don't want to buy it at this price, I'm just going to continue to operate it because I have never seen so much cash flow from this building.
That's absolutely beautiful. And I think it's a great way of saying why we get so much confidence. But me personally, and I'm sure Angel can chime in on this, I get a lot more confidence in what I expect to happen in the future from hanging out with people. George, you have your meetup every Wednesday, and I don't have a fancy triangle to cover our faces, but I do have one for our Marvelous Mondays. And if you ask about the Wednesdays, we'll be happy to give you the link to register for that, or maybe you can drop it in the chat later there, George. But Angel, do you want to say a thing or two about Marvelous Mondays?
Absolutely. We get together every Monday at noon Eastern, and we hang out and talk real estate. It's pure networking, and the Wednesday meetup is also pure networking. So we're just hanging out with people. We've got 25 to 40 people that are other investors. They're other aspiring syndicators, experienced syndicators. We've got some strictly passive investors, and we all come together and share knowledge, share experiences, and it's just a lot of fun, and we'd love to see you there.
Excellent. So you can use the link that's on the screen, or if you have your phone handy, you can pause this replay. If you're watching it, if you're not watching it live, you can scan that code. I guess to save a little bit of time, I should also mention that if you want to get all of the summit recordings and you're getting used to watching at 1.5 times speed or 2 times speed or something like that, you can scan this code here and get access to all. Is it 7 summits now that we've done, or is it 6?
Yes. 7.
7, exactly. So it's a lot of stuff. It's a lot more than 250 hours. But we are here with George Roberts III. We're discussing what's going on, and let's continue. Here we go.
All right, we also might be up for recession, and it's really difficult to say exactly what will happen next. Nobody knows. I think we've been expecting a recession for quite some time. We saw 2 consecutive quarters of negative growth, normally almost 100% correlation between that and recession. But what's going on is that, well, the labor market is still firm. And why might that be? Well, I don't know. We just printed a whole lot of dollars. So you may not expect to see the ordinary relationships we do see in macroeconomics. But again, hey, we have to figure at some point we will see a recession. So what happened the last 4 times we had a recession? Well, it turns out that prices just continue to march up. Now, notice we're using core logic here, not Case-Shiller, which started in 87, wouldn't allow us to see those first 2 recessions. But I mean, it's a pretty strong correlation between rates, with home prices continue to march almost unabated through these recessions. And I can show you the graphs. They tend to level a bit. Prices don't go up nearly as fast as they do during stronger economic times. But again, we're only seeing 2 recessions where we lost ground, and one of them was very, very mild. Now, to be clear, that 1991 recession referred to here, we're already at 2.5% price decline. So things are clearly worse than the 1990 recession. However, it's not likely to be anything like the 2008 recession. And again, you'll notice we're looking at core logic figures. These are slightly different than Case-Shiller. Actually, I think I could just superpose that over the core logic. Looks like we got some time here, and you can see, I mean, yeah, you can hardly tell. If I didn't have those gray bars there, it would be a little bit difficult to tell, gosh, when even did we have a recession just by looking at the home prices? Well, you would hardly know. All right, so we still do have inflation, and the numbers came out, I want to say, was just this morning, and I think we were looking at about 5.5 for core and maybe just a little bit above 6 for headline. But I mean, we're coming down, right? So it's hard to say. We don't know. Are we going to have another run up in inflation? Will it run sideways for a little while? But I would say either way, you're pretty good with real estate. Notice that during the decades of the 70s, 80s, 90s, 2000, 2010s, that home prices tended to keep up with, or even in some cases, significantly exceed the inflation rate. So again, regardless of whether you actually believe the inflation rate is real or whether the statistics are a little cooked, I can hear Angel laughing a little in the background. I think we all believe that those official statistics are a little bit behind the mark. However,
all right, hey Dan, you want to stop for a second? So I did show some stats there about the severity, and we are already doing a little worse in this current recession than the 1991. But again, that was so mild, hardly anybody seemed to notice it, at least today. I mean, wow. I mean, if you were alive at the time, you probably remember, but I mean, it's nothing like the living memory of that Great Recession. So just double checked, and it looks like it was 2.93%. So if we've actually bottomed out now, and it looks like we might have from our early data from March, at least temporarily, 2.93%. So, I mean, this is hardly severe. And especially when you remember that we've seen such amazing increases in home prices since 2020. I mean, did you really think all of that was real? If we have to give back a little bit of that compared to a very strange and anomalous peak, it's almost like nothing.
Yeah, no, I was really surprised that we're continuing to see hikes from the Fed. I feel like it's continuing to use a tool that's broken, and it's not producing the desired outcomes. Because I mean, what did we have now? Is it 5 banks that have failed?
Right.
That can't be the desired outcome.
Right. You're trying to hit 2 targets with essentially one lever of your monetary policy. And yeah, I consider it bloodletting.
Well, it's putting your foot on the accelerator and the brake at the same time, right?
Well, yeah.
Yeah. Awesome. So we are here. This is the REI Rocks Review. We're here every Friday at 11 a.m. Eastern, and we're reviewing George Roberts III's presentation. It's highly informative. You got to check out this data and its interpretation. This is fantastic stuff.
Taking into account cash flow, amortization of your loan, or the tax benefits of real estate. So, hey, these may be uncertain times, but it could be the very best time to invest. we also have to remember that real estate is hyper local. Now here we're just looking regionally, but whereas you see that we don't have a whole lot of affordability right here. I mean, your median family income and the qualifying income across the United States, I mean, literally your average person cannot qualify for the average home at this point. And that's sad. But there are some bright spots. And what I'm taking out of this is that there are some places like the Midwest, for example, that I do expect to do better. And again, we're taking some very, crude, very large scale generalizations here, but I think at some point we can't all move to the San Francisco Bay Area. The affordability is just not there. And so I think you're going to see people moving into some areas that are maybe desirable in the Midwest, like maybe say Cincinnati, or maybe some parts of the South that are not yet so heavily appreciated. I've been looking a lot at Kentucky and Tennessee, particularly East Tennessee, as places where I think are affordable and could very easily be continuing to attract people and possibly continue to see those rent increases that we've come to expect. I don't have a visual for this, but I saw a recent article that said, apart from Orlando, rents are just dropping just about everywhere else in the country. And a little bit of hyperbole there in the headline, but the idea I think is right. A lot of places we're seeing rents soften or level off. And there are some areas like, Florida is just attracting people like nuts. And there are certainly other markets that are seeing some rent.
I guess we could mention that Wichita Falls isn't dropping. Texas, look it up. Google Maps, it's a thing. Wichita Falls, Texas. I'm just putting it out there.
Increases, but I think we really need to start to focus on affordability. Now, through all this, I would say that wage growth has been pretty healthy by historical norms, but again, not even keeping up with the official inflation statistics. Now, meanwhile, you might wonder, like, oh, are people losing their houses? Well, maybe I'll just wait for that foreclosure crisis. When that next foreclosure crisis comes, the price of real estate is going to drop, and maybe even multifamily real estate will drop in a significant way. Well, I don't really think that's the case, because if you look what's happened, everything from the credit profile of borrowers to the fact that it just really hasn't made any sense to get an ARM in, I would say, maybe almost 10 years, right? I mean, if you have a very slight spread between the ARM and the fixed, well, why would you go for the ARM? It doesn't really make a whole lot of sense unless you have very strong knowledge that you're going to only be in a particular place for a long time. If you think that you're going to be there for a few years, doesn't make any sense. So the product risk has declined precipitously, and meanwhile the borrower risk has declined as well. So I don't really see a whole lot of room for another foreclosure crisis. Now, I think it does behoove one to be very careful, and I would say cash reserves mean a lot right now because we don't know what's going to happen. But if you're on the sidelines thinking, oh yeah, apartments are going to be on sale in a big way in the next 1 to 2 years.
This is before 5 banks crashed.
Be careful out there.
Just a little aside, you can
I'm just
continue if you want.
Seeing blood in the streets. Now let's take a look at foreclosure starts. I think this is a great example. This is a great example of the sort of scare headlines, like, oh, foreclosures are up, I don't know, 2x, 4x, 3x. Yeah, sure. But they're down from historic lows. We had a moratorium. We're not even back to normal levels before the global financial crisis. These are extraordinarily low levels. So are foreclosures up? Absolutely. Would you expect them to be? Sure. But are we going to see a crisis? I don't think so. And home prices were already turning around by 2011, and you can see the foreclosure level there. So if we're not seeing, again, it's not, I'm not seeing it in the numbers, and I could be wrong. Now here, let's take a look at homeowners equity. That's another really important thing to look at. And you'll see that the equity levels are relatively high, at least by recent standards. Now, one of the things that pushed them down, and I think I have another slide for this, is that prices did decline. But you'll notice that people saw a decline in their equity even before the prices declined. And so why is that? People were using their homes as ATMs. And when you saw rates go down, in a very long-term sense over years and years, I mean, literally since the Volcker era, I mean, well, why would you worry so much, right? I mean, you have more equity than ever. And just look, I mean, well, we could probably refi again if we have to. We'll probably take money out in again another 6 months. Well, that didn't turn out very well. But this time, I think a lot of people, once bitten, twice shy, or as some say, he who gets burned on soup blows even on his yogurt. So we're not seeing people do that this time. We have very high homeowners equity. So this is another reason why we're not going to have an issue. So people are not moving, but even people who might want to refi, cash out, et cetera, that those increases in rates are certainly going to put a damper on that. All right, yeah, I think we can go through prior housing recessions. Looks like we have a little ways to go. I guess I'll call for some questions soon. I know Angel, especially when it comes to economics, has some great questions. I don't know if you can see the dual screen, but I can see her smiling, and I like that. Okay, let's compare it to the Great Recession. We had a huge oversupply in 2008. Now we have a significant undersupply. Home equity, as we saw on the last slide, was low, and now it is quite high. We just don't see people underwater. So, I mean, at this point, we don't have the issue of that that the bank is just going to come in and foreclose. I mean, people can maintain. We have people working, etc. Increase in money supply was significant this time, and that's driving a lot of inflation and probably a lot of the silliness that we're seeing in the macroeconomic space. I mean, we haven't seen the recession yet, but then again, well, should we expect it to come yet? I mean, at least we're judging that a recession involves loss of employment. Maybe not. I mean, there's a lot of monkey business going on. Mortgage rates dropped during the Great Recession, as you'd expect. That's what happens. I mean, the Fed lowers rates, and that's going to impact everything. This time again, and I've left that top line number 7.08 there because I just want people to get an idea. I mean, this is the sort of thing that we've been up against. This is what really took us down from those all-time highs. And we saw a 26% price drop, and this is from Case-Shiller. So again, you'll notice that's a little different than the CoreLogic number. So we don't know what's going to happen this time. But again, we're already seeing only a 2.5% drop, and the rate of decline is less each month over month. And I believe the latest statistic that was available as of mid-February is December, and hardly decline at all. I mean, it's really leveling off. So if those rates slide sideways, who knows? We might even see an increase in home prices by the end of the year. Wouldn't be surprising to me. Now, this is from
I'm just going to pause it right there because I think some people might watch this and it might just reinforce the false impression that when people invest in real estate, when people syndicate deals, things like that, that it's a lot of rolling the dice and just saying, hey, I hope this works out. You know, it's like it's real estate. Real estate goes up in price. It's like, yeah, not all real estate, but really it comes to underwriting. And of course, we have our resident underwriter, chief underwriter, and fashionista on here. Jason, do you want to say a thing or two for people who might have more room in their underwriting? Okay, that's just a silly joke, but you're coaching these days on underwriting. You want to say a thing or two about what you have on offer?
Yeah, I am coaching underwriting. I think a lot of what has happened in Houston and some of the doom and gloom that is being broadcast out there, people are starting to worry. And so if you get your underwriting down and sound, you can start mitigating risks and you can start maximizing profitability if done properly. If you just follow some YouTube video and fill out some spreadsheet you may have downloaded somewhere, who knows where you're going to be. So if you're interested in learning how to get more confidence and certainty in your underwriting, just hit me up. I'm on LinkedIn mainly. So you can also go to the link there, and I believe there's a sign up form there.
Yep, for sure. Yeah. And, I know that I was in a commercial real estate mentorship for a year and a half. And, part of it was doing underwriting and most of it was just to create an LOI. But underwriting can be as far as creating your entire business plan, figuring out that roadmap for, sure, this year will look like this, but what about next year? What about the year after that? So I think it's really important to have that all figured out. And then, George in his presentation here, he mentioned about how real estate is hyper local. So you're still going to need to have a firm grip on what's going on, in your area, around the country, and all that sort of stuff to figure out what investors are going to be interested in doing. But you are watching the REI Rocks Review, which happens every Friday. We start at 11 a.m. Eastern. We're streamed on YouTube, on LinkedIn, on Facebook, on Twitter. We're everywhere, and we're going to continue thanks to George's lovely presentation. Let's get back to it.
Lawrence Yoon, he's got some additional info here. I'd like to focus on subprime loans. We saw that a few slides back. Virtually none. Credit profile has greatly improved. And we also see we have very little inventory on the market. Why? As I showed you, we don't have homes being built, and those currently existing homes, people just don't want to get out of the current mortgage. Makes sense. Mortgage delinquency is relatively low, and our homes in foreclosure, very, very low. So does this look like the Great Recession? Not to me. So here is what actually happened. We saw interest rates decline 3.5% rather than 4.5% increase like we've seen, and a major, major home price decline. So those interest rates declining was not enough to pick things back up. Fed did everything they could to ease the situation, and it was just literally beyond the issue of interest rates. This time, it's interest rates all day long. 1990 housing recession, as I promised, we showed further statistics. We were sort of balanced going to 1990, but again, we have a huge undersupply here. I'll focus on 1990 since you've seen the right column already. Home equity was high again, maybe one of the reasons that things were mitigated, also the balanced housing supply. And we didn't really monkey too much with the money supply. Mortgage rates went down slightly, as you'd expect, because it was a mild recession, and we saw a mild price drop. And here's just to see the tail of the tape in terms of charts. Let's see, I think this is just basically just a wrap up here. We have huge differences between this and the last crisis. So am I predicting that we're not going to see any further issues? Not necessarily. If we see a further price decline, I wouldn't be surprised. I'll be shocked if we see major price declines like we've seen in Canada, Australia, or in China. But I do believe that it's probably going to be a good while before we see things pick up again. And who knows, again, maybe by the end of the year when those statistics come in, I would be surprised if we are in a very different situation. And now it looks like I've saved quite a bit of time here for Angel. Angel knows all about my presentation. She's seen it before. So if you want to go into details, Angel, if you want to start asking questions, or I can go anywhere from here.
Okay, so I was just going to talk a little bit about where we're at and why the lack of supply is having such upward pressure on price. And part of that is because these graphs are looking at specific moments in time. And so today, housing supply is XYZ level. So you're moving along the curve as to what the quantity demanded is going to be, right? So you can't scoot the curve until there's more supply. I think of it like a trash bin. And so when I explain to my students, I'm like, okay, you got a trash bin. And if it's not very full, a lot of times that little sag down, right? So as we gain supply and more supply goes into the trash bin, it's going to pop the lid. And that's what's going to actually increase supply, because an increase in supply is going to increase the entire curve. And so that will have that increase in supply, so long as demand isn't actually moving, will have a decrease effect on the price, because you're giving more people the option. So there'll be more houses out there. Now, tons of other things play into that. What's the interest rate? What kind of disposable income do people have? What kind of savings do people have? A lot of things play into that. But all of that is kind of encompassed in where the demand is sitting. So you just have to think about, like, until more supply is created, you don't have a lot of movement in the prices based strictly on supply. Now, when you add in the other stuff, you're looking at the rates, you're looking at other stuff, that can affect. But so long as we're only talking about supply, so that single variable supply, there's not a whole lot that can happen until we have more supply. So
well, absolutely. Oh, go ahead. Sorry.
No. I was just like, I know people, we tend to think of all these variables, and it's really difficult to consider each variable and its effect. You want to kind of look at each one individually, and then you get a better idea of what's going on. And then you can make some combinations. But when you're talking about, you really want to be thinking about one variable, because when you start combining them in, it gets super complicated, and you won't actually know what variable on its own, like that isolated variable, what that variable is having the effect. You won't be able to pick it out. So
oh, absolutely. Yeah. Economics, what a complex science. So many moving parts. And it occurs to me, one of the things that I didn't mention is that we really need to see that we're going to see a pretty large gap between the decline in interest rates, which you'll notice I flagged here as happening in, it was the end of October, and then I think it was early November again, and when home prices can pick up. So since, I want to say it was, and let me just see if I can go a little further, I got one that does map this out a little better. But yeah, I mean, since mid-November, mid-November, we have, oh, did I stop my screen share?
Yes.
Darn it. You know what happened is when I closed it, I had to start all over here because I didn't have my two screens going, something like that. All right, yeah, let's do it again. No, that's not the right screen, is it? Ta-da. Yeah, it's taking a moment. But what I want to tell you, and regardless of whether we get the visuals back up or not, is that since maybe mid-November, we've had rates in the mid-sixes. And you have to expect that that's going to take a little time to show up, right? We're going to have to go, here we go. It might take, another couple of months before it shows up in the statistics that we actually have leveled off. But again, you see rates declining almost up to the very present. So it will take at least, say, 45 to 60 days from today, again, middle of February.
So, George, one of the things you just said there was that, we're not going to see the information. It's not going to come out for a little bit. So that's one of the other frustrations I have with, let's continue to increase rates, right? What if we're already in self-correction? Because things self-correct. What if we're already in self-correction, yet we're continuing to see those interest rate changes? How bad is that going to exacerbate the problem that we're already facing?
Yeah, absolutely. And by the time you see it in the unemployment, I mean, we are really rather deep into it.
Yeah, I don't know. These are those times when I get super, super frustrated, because so the economy will self-correct. It works in cycles, business cycles. We learn about those things. It just happens. We go up, we go down, we go up, we go down, but they will self-correct. Issues will self-correct. And then when we have all of this manipulation in there, I mean, we may have already been in self-correction 6 months ago. And we don't know that because not all the data's in. And so the rate hikes are continuing to happen. We're continuing to have this monetary policy that could be like really skewing us further. And so we're going to see worse problems with our production levels. We're going to see higher unemployment. And the fact that we're trying for this 2% just kills me, because that's not even the natural rate. Like trying to go below that natural rate. So, you'll hear people say the dollar loses 3% value per year. It's been like that forever, because 3% is kind of that natural rate. So if you're trying to go to something superficial like a 2%, it's not only unsustainable, I don't think it's actually attainable. And what we're doing with this continued rate hike just blows my mind.
Yeah, I'm sorry they didn't consult with you, Angel. They didn't call me either before that last rate hike. So it's a little bit disconcerting.
Yeah.
Definitely.
I don't know. I'm wondering, at what point do we decide that we need a different approach? When does that happen? What numbers have to be hit before things are changed?
Yeah, I don't know. I mean, we could dream about a society that's very macroeconomically sophisticated and realizes, hey, some of this prosperity we've seen since we printed tons of money is fake.
Yeah.
And not give so much credit to the present, realize that there are these lags. And so when you do go into the voting booth, and of course, we're all going to make different decisions, but just if people would just realize that there is a significant time lag between these policies and their impacts, don't just look at what's happening today when you go in the voting booth. Who produced the policies that put us to whatever it is today? And I'm just using today as an example.
No,
Yeah,
absolutely.
that's awesome. That's awesome. And you guys have been talking about this, and in the back of my head, I had Ethan Gow's voice. and what he was saying is that, okay, so macroeconomics, that it's more than just a hobby for a bunch of us in this circle here. We got Andrew Rosenberg, we got Douglas Dowell, like lots of people thinking about macroeconomics all the time, people who aren't on this call. But how do you make money off of this is one of the big questions that I hear Ethan saying in the back of my head. And I know that part of it would be like, if you see inflows, population inflows, people moving to a certain area, then that is an indicator that there's an increase in demand, which means that there should be the ability to raise rents. So that's one, low hanging fruit. George, what thoughts do you have as far as how to make money off of looking at these numbers and understanding?
Well, I love the question, but maybe I'll turn it on its head. Is that how do you use this information to make sure you're not losing money? Because if you can manage your way through the recession, if you don't slide significantly, then boom, you are in position for the next leg up. And think of it like the winner's competitive cycle. I mean, if you can just hold on to your units, don't lose anything, don't lose any money on your deals, build up that war chest in case something goes wrong, and then boom, when things take off, you're going to be in great position to take great advantage of it. So yes, I want to make money off of this, but more than anything, I just want to make sure that I don't get swamped from the recession.
Well, and you're touching on a really cool concept too. And like when you're talking about like not losing, you're talking nominal, which is actual dollar terminology. But if you're not losing during this time period in real terms, you're gaining.
Mm-hmm.
So really making that distinction between nominal versus real, and understanding that there's a lot of people that they're losing out right now.
Yeah.
And beyond the fact that they're losing out, there's some of that real loss too. But if you're not losing, you may be thinking, well, I'm not gaining either. But that's strictly nominal gains, which may not be real. But if you're not losing, you are making real gains. And so those are they're real gains, even though there may not be anything nominal there. So you may not see it in the dollars, but you're going to see it later on in the actual worth, the actual value, the purchasing power, however you need to think of it. Those things are going to be real term increasing, even though that dollar may not change.
Some people might call that just getting closer to retirement, like assuming that's their goal, right? Some people, they don't want to like actually retire, and they're more, thinking and, like, how do I, do better than my parents, for example, or something like that. It's I think that's really great stuff, but we're running low on time. We like to keep these down to 45 minutes now. We normally do the takeaways, the doggy bag. I'm going to pick on Jason and ask you first, like, what are your thoughts from this presentation?
My thoughts on this presentation is I'm probably going to have to watch it 2 or 3 more times to figure out exactly what's going on, because there's a lot of data here, and I might have to actually watch it at like 0.75 speed just to slow it down a bit. But I know the only way you can do that is if you have a VIP membership right now. So I'm just throwing that in, but
Just throwing that out
definitely.
there. Just
Yep.
ways to keep the lights on, pay them more money. There's that code in case you haven't. I also like to remind people to subscribe because it's yummy, and subscribing is something you can do on YouTube. And if enough people actually click the button, then they start to pay us for this content, which I think that would be amazing. It's a goal. But George, did you have any thoughts from your presentation that you want to share on top of this?
Well, yeah. So here's your doggy bag. We didn't have a crash. I don't think we will. I think that prices are on their way back up. So be prepared for it. Don't expect it. Rates could go up. So I still don't like that variable debt, even though I believe that we are at the top. There's a big difference between the certainty you need to say like something is good, and if this happens, it'll be okay. That's one thing. But if you're banking on it, if your deal depends on it, that's a whole other level of certainty, and we certainly don't have that at this moment. So watch out, be careful, but I do think that things are improving, and don't be surprised if we do see significantly higher prices by the end of the year. And maybe even, as Angel was pointing out, we always have to consider inflation. We might even see higher prices in real terms, not just nominal terms.
There you go. So, Angel, how about you? What's your takeaways?
I think really the biggest takeaway is there's a lag in data. The data that's reported, people take it and say, oh, that's what's happening today. But it's not. The data that's being reported now is, it may be a month old, 2 months old, 3 months old, maybe more. So just realize that there's a lag in data and kind of just understand that it's old. It's not today.
I love it. I love it. And, you mentioning that and also having George here, it's reminding me about his partner in some deals anyway, Greg Scully down in Tennessee. And like one of the things that he taught me that I felt it marked a new chapter in my own commercial real estate career. It's when he mentioned that, all of these, bigger details, they kind of fade away when you are invested in a particular property, and then that's when the hyper local thing comes in. And so when it comes to like making money from all this knowledge and data and all that sort of stuff, I think one of the barriers that people will run into is just not having a group of people who can support you in your business. And we need to sign off, but I did want to mention that we have a new cohort of masterminds coming up just that's about like 4 weeks, because we're starting it in June. So if you want to get together with a group of people to discuss your business and figure out how to move it ahead, we're commercial syndicators in this group. So that is the link for that. I don't know, maybe Jason, you want to say a thing or two about that before we give everybody their day, but otherwise they could just reach out. What do you got to say?
Yeah, I can. This mastermind, I know a lot of times you see, hey, sign up for my mastermind, and you're signing up with like 500 different people, and they all pay 35 grand to be part of it. Well, no, this is a true mastermind where we're limiting it to 12 people tops. 8 to 12 is the ideal number. And that's why we have a close, intimate group where we hold each other accountable. We know everybody's businesses ins and outs, and we can help support each other grow their businesses. And that's what it's all about, is leveling up with close, like-minded people. So
Beautiful, beautiful. All right, then. So thank you very much, George, for joining us. This has been an awesome REI Rocks review presentation. I hope to do this again soon. You know, we're going to have our next one. It's in October, right, Angel? The next one?
September?
September, October, one of those.
It's September.
for-
It's in
Promise.
September.
Months.
September. We actually
Excellent.
have dates. I can spit them out. Hold on a sec. What are they? They're September
All right.
20, 21,
25th, wasn't it?
22.
Nope.
Oh, okay. 21st,
21 and 22.
21 and 22. There we go.
Yeah, we're
Good
doing a
stuff.
Wednesday, Thursday, Friday. So we're not going to be taking up your weekend.
For sure, for sure. And so thanks again, George. I see that you mentioned about the Case-Shiller data. Do you want to say that before we give
Well, yeah, I
everybody
love
the data?
Angel's insight about how there is such a lag. You got to remember it. I think we recorded in March, and so we just got the Case-Shiller for February, and a couple days later, we got our median home prices for March. So, I mean, again, that is one of the tremendous difficulties in making policy, as the Fed does, or even on commenting on it, because I'm only able to tell you what happened a couple months back. And what we really need to do as investors, we need to know what's going on right now. There's always that gap. That's what keeps it exciting.
All right. Great.
Keeps us on our toes.
For sure. For sure. All right. So thanks again, George. This has been fantastic. And thank you for watching this REI Rocks review. Be sure to check us out again next Friday and every Friday at 11 a.m. Eastern. That's all I got. Bye-bye.
Yeah.